Is American capitalism in crisis?
Yeah, it's a kind of rolling crisis that starts very slowly, a bit like bankruptcy, very slowly. I suspect selling everything would work out just fine.
Wall Street's in a panic over Jeremy Grantham's latest warning. Is the market about to collapse? We'll cut through the noise and help you decide if it's time to act. Jeremy Grantham is no stranger to Wall Street. As the co-founder of the investment management firm GMO, he has a long and distinguished career and is known for his insightful yet contrarian views on the market. He's earned the nickname the Prophet of Doom for his past predictions of market downturns, some of which have proven unnervingly accurate. So when Grantham speaks, investors tend to listen. Grantham is currently worried about a possible super bubble in the stock market. He thinks that stock prices have become significantly overpriced when compared to the underlying corporate earnings. According to Grantham, the US stock market is in a bubble and could potentially experience a 60% decline. This disconnect is not sustainable and might lead to a sharp decline in stock prices, which is commonly referred to as a dramatic correction. The current state of the stock market is a concern due to its overvaluation, which is measured by the Shiller PE ratio. This ratio compares the stock market's price to the average inflation-adjusted earnings of companies over the last 10 years. At present, the Shiller PE ratio is close to 34, a figure higher than the highest point before the 1929 stock market crash. In addition, Grantham argues that corporate profits are unsustainably high and will eventually return to more normal levels. This, in turn, would cause the Shiller PE ratio to rise even higher, further exasperating the stock market's overvaluation. What evidence does Grantham provide? Grantham points to the historical market crashes as evidence for his concern. He highlights similarities between the current market climate and periods that preceded major downturns, such as the dot-com bubble crash of the early 2000s. During those times, similar patterns of inflated valuation and investor overconfidence paved the way for significant losses. It's important to acknowledge that not everyone agrees with Grantham's dire predictions. Some experts believe that the current market, while frothy, isn't necessarily on the verge of collapse. They point to factors like a strong global economy and continued low interest rates as reasons for cautious optimism. So how should investors approach these seemingly conflicting viewpoints? In the world of investments, it's important to make informed decisions based on reliable data rather than sensational headlines. To gain a better understanding of the economic factors at play, it's essential to consider some key indicators. These include the price-to-earning ratio, which compares a company's stock price to its earning per share. A high PE ratio can suggest an overvalued stock. Additionally, rising corporate debt can be a red flag as it can make companies more vulnerable to economic downturns. Interest rate hikes by the Federal Reserve can also significantly impact stock valuations. Even if Grantham's prediction does not fully convince you of an imminent crash, it's always wise to exercise caution in the stock market. To minimize your risk, consider diversifying your investments by spreading them across different asset classes such as stocks, bonds, and real estate. Another strategy to consider is dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of the current stock price. This approach helps you average out the cost of your investments over time. Lastly, it may be helpful to consult a qualified financial advisor who can help you create a personalized investment plan that aligns with your risk tolerance and financial goals. What are some alternative investments to consider? If you've become spooked by Grantham's warnings about the traditional stock market, consider alternative investments. These investments can provide diversification and potentially reduce your overall portfolio risk. Real estate is an investment option that can provide rental income and potential for long-term capital appreciation. You can choose to own rental properties directly or invest in real estate investment trusts that pool investments according to a variety of properties. Another alternative investment option is commodities, such as precious metals like gold and silver. These have traditionally acted as a hedge against inflation and market instability and can add stability to your portfolio when stocks are volatile. Cryptocurrencies are a highly volatile and risky asset class that has attracted attention due to their potential for massive gains and equally massive losses. A small, calculated investment in crypto might make sense for investors with a high risk tolerance. Investing in startups and private companies can offer the potential for outsized returns, but comes with a very high risk. Thorough research and consultation with an expert are essential before considering this path. It's important to keep in mind that alternative investments can carry unique risks and complexities. Conducting thorough research or consulting with a financial advisor before diving into these assets is highly recommended. Short-term market fluctuations, even major ones, shouldn't derail your entire investment strategy. Historically, the stock market has demonstrated a general upward trajectory over longer periods. Panicking and selling during a downturn could mean locking in your losses and missing out on potential future market recoveries. This is where a disciplined investing approach and long-term mindset pay dividends. Staying invested, ignoring the day-to-day noise, and focusing on high-quality companies with solid fundamentals often leads to positive long-term results. What else is Grantham known for? While known for his market bubble predictions, Jeremy Grantham's contributions to the investment world go beyond just forecasting downturns. He's a strong advocate for sustainable investing and recognizing the long-term consequences of climate change. Navigating the world of investment can be overwhelming. There are many conflicting predictions, sensationalized news, and fear-mongering. It can be challenging to distinguish valuable insights from the noise and make informed decisions. However, striking a healthy balance requires a few essential steps. Firstly, it's crucial to rely on trusted and reputable sources for market insights. Turn to analysts and news sources with proven track record of accuracy to filter out the noise and gain valuable insights. Conducting thorough research and analysis before making any investment decisions can go a long way in ensuring that you're well informed and confident in your choices. Secondly, it's crucial to avoid making impulsive decisions based on short-term market fluctuations or sensationalized headlines. Resist the urge to panic and instead focus on the bigger picture. Consider your investment goals and objectives and avoid getting sidetracked by short-term market noise. Thirdly, stay informed, but don't become obsessed with checking your portfolio every hour. While it's essential to stay aware of market trends and economic indicators, remember that investing is a long-term game. Focus on your long-term plan and trust the process. A well-diversified portfolio with a mix of stocks, bonds, and other assets can help you regardless of market ups and downs. Lastly, if you're unsure about the investment decisions, don't hesitate to consult a trusted financial advisor. Financial advisors can provide personalized guidance tailored to your goals and risk tolerance, giving you the advice advantage you need to make informed decisions. They can also help you navigate complex financial markets and provide you with valuable insights and recommendations. It's important to consider your unique circumstances before making investment decisions based on market predictions like Grantham's warning. To help you approach potential market volatility, consider several factors. Age and retirement plans play a crucial role in determining how much risk you should take. Suppose you're a young investor who has plenty of years before retirement. In that case, you may be able to handle more risk in your portfolio as there's a greater potential for rebounding from market crashes over an extended period. On the other hand, if you're nearing retirement, reducing portfolio risk may be a top priority to ensure your retirement savings remain secure. Another important factor to consider is your need for liquidity. If you have planned significant expenses like a down payment on a house or college tuition for your children, you may want to reduce the risk in your portfolio and shift assets into more stable investments. This will ensure that you have access to your funds when needed. Additionally, it's important to take into account your comfort level with market fluctuations. If you feel anxious or unable to sleep at night due to market dips, it may be wise to reevaluate your investment strategy. Adjusting your asset allocation to favor less volatile investments could provide you with peace of mind, even if it means potentially slower gains. After all, investing in a way that negatively impacts your mental well-being is never worth it in the long run. Overall, taking the time to consider these factors and making informed investment decisions can help you achieve your financial goals and secure your financial future. Savvy investors take the time to evaluate their portfolios, seek expert guidance, and adjust their investment plans strategically. This allows them to mitigate risk, sleep peacefully at night, and remain focused on their long-term financial goals. While timing the market perfectly is nearly impossible, preparation, informed decision making, and aligning your investments with your circumstances will put you in the strongest position possible, regardless of short-term fluctuations. In the end, it's not about getting rich quicker, it's about steady, disciplined wealth building. And that's it for this video. We hope you enjoyed watching it and learned something new. If you did, please give the video a thumbs up and share it with your friends. Also, don't forget to subscribe to our channel and hit the bell icon to get notified on our future videos. We have more amazing videos coming up, so stay tuned. Thank you for watching. See you in the next video.